Currently, the price of gold sits at $2,773.7 US per ounce, and it's not just rising on its own. President Donald Trump's trade policies, especially his aggressive tariffs on imports, are sending ripples through the global economy, and gold is caught right in the middle. These tariffs are shaking up markets, weakening the US dollar, and sparking fears of inflation. The result? Investors are turning to gold as their safe haven asset. But with prices at an all-time high, the big question is, should you buy, hold, or sell gold? Stick around and don't forget to like, share, and subscribe to Economy Explorer so you won't miss a single detail, and make sure you don't skip any part. What's driving gold prices today? One of the biggest contributors to today's soaring gold prices is the uncertainty created by President Donald Trump's tariffs. These aren't just any tariffs. They're targeted measures aimed at imports from major economies like China, the European Union, and even some of America's closest trade partners. On the surface, the goal is to protect American industries by making foreign goods more expensive. But beneath the surface, these tariffs have triggered a domino effect that's rippling across global markets. For businesses, these policies mean rising costs, higher prices for raw materials, disruptions in supply chains, and increased manufacturing expenses are forcing companies to either absorb the cost or pass it on to consumers. The result? A growing fear of inflation, and when inflation looms, investors flock to gold like moths to a flame. Why? Because gold is seen as a safe haven asset, a reliable store of value when money starts losing its purchasing power. But that's not all. Trump's tariffs are also hitting the US dollar hard. As global trade slows and tensions rise, the dollar weakens. And here's the kicker. When the dollar loses value, gold becomes a lot more appealing to international buyers. Think about it. If gold is priced in dollars and those dollars are worth less, the same amount of gold suddenly costs less in their local currency. It's like a sale on gold, and demand skyrockets. This isn't just an isolated reaction. It's a classic economic relationship. When the dollar goes down, gold tends to go up. And with the uncertainty surrounding these trade policies, the dollar's weakness is fueling a surge in gold's appeal. It's no wonder analysts are calling this the Trump effect. His tariffs are directly influencing one of the world's oldest and most trusted investments: inflation, interest rates, and their gold connection. Inflation is another key factor driving the surge in gold prices. When inflation rises, the value of money declines. It's like having a bucket of water with a slow leak. The higher the prices of goods and services climb, the less your money can buy. In these scenarios, gold steps in as a reliable store of value. Unlike paper currency, which loses its purchasing power over time, gold has historically maintained its worth, making it a go-to asset for investors during inflationary periods. But the story doesn't end there. Central banks, particularly the Federal Reserve in the U.S., play a critical role in controlling inflation. To stabilize the economy, they often respond to rising inflation by increasing interest rates. Higher interest rates make borrowing more expensive, which slows down spending and, in theory, helps to bring inflation under control. Here's where it gets tricky for gold. When interest rates rise, assets like bonds or savings accounts become more attractive because they offer better returns. Gold, on the other hand, doesn't generate any income. It doesn't pay interest or dividends. This dynamic typically makes gold less appealing in a high interest rate environment. However, the unpredictability surrounding President Trump's tariffs is changing the game. Despite the Fed's efforts to keep interest rates high, gold is holding its ground. Investors are hedging their bets, unsure of how long these tariffs will continue to disrupt global trade. They see gold as a way to protect their wealth against an unpredictable future, where inflation, trade policies, and economic growth could take unexpected turns. Even central banks around the world are increasing their gold reserves, signaling a lack of confidence in traditional currency and market stability. It's a clear indication that, while high interest rates may pose a challenge, gold's timeless appeal as a safe haven asset remains intact. Global economic uncertainty, a key player. The global economy adds yet another layer of complexity to the rising price of gold. In recent months, we've seen a perfect storm of factors that have left investors on edge. Rising oil prices, driven by supply constraints and geopolitical instability, are putting upward pressure on the cost of living and production worldwide. These higher costs ripple through economies, amplifying inflationary fears and driving investors to safe haven assets like gold. But it's not just oil prices causing concern. Geopolitical tensions are at an all-time high. Whether it's conflicts in key regions, trade disputes between major powers, or uncertainty around global alliances, the fear of instability is pushing investors to seek shelter in assets that can weather the storm. Gold, with its long history of providing stability during turbulent times, has become the asset of choice for many. Another major player in this story is the actions of central banks. Around the world, central banks are ramping up their gold reserves. Why? Because gold isn't tied to the policies of any single government or economy. It's viewed as a universal asset that retains its value even when global currencies falter. This surge in central bank buying further underscores the lack of confidence in traditional financial markets. And let's not forget the lingering effects of Trump's trade war with major economies like China and the European Union. These trade disputes have disrupted supply chains, slowed down global trade, and heightened economic uncertainty across the board. Businesses are left guessing what's next, and investors are shifting their strategies accordingly. In uncertain times like these, gold becomes more than just an asset. It becomes a lifeline. With so many moving parts in the global economy, it's no surprise that gold is experiencing a surge in demand. It's the one asset that transcends borders and provides a sense of security when the world feels anything but stable. Buy, hold, or sell. Let's decide. So, with gold prices hovering near record highs, the big question is, should you buy, hold, or sell? Let's break it down, because your decision depends on your current position and your expectations for what lies ahead in the global economy. Buying gold. For those considering buying gold, the key is timing and foresight. If you believe that the current economic uncertainty, driven by Trump's tariffs, inflation fears, and global market instability, will persist or even worsen, then gold could be a smart addition to your portfolio. Analysts point out that gold's current support level, near $2,650 per ounce, suggests opportunities to buy during minor dips in price. And remember, gold isn't just about short-term gains. It's a long-term hedge against economic shocks, currency devaluation, and inflation. However, buying at a high price comes with risks. If trade tensions ease or central banks pivot away from gold purchases, prices could stabilize or even fall. That's why experts recommend a balanced approach. Don't overcommit, but use gold to diversify and protect your overall investments. Holding gold. If you already own gold, congratulations, you're in a good position. Holding on to your investment might be the best strategy in the current climate. Why? Because all the factors driving gold prices, like inflation, geopolitical instability, and a weaker dollar, haven't shown signs of easing anytime soon. Historically, gold has proven its ability to retain value during economic downturns, and the ongoing uncertainty makes it a reliable asset to hold. Central banks are leading by example here. Many are holding on to gold reserves or even increasing them to safeguard against currency fluctuations and market volatility. For individual investors, following this trend and holding steady could provide a sense of security and stability. Selling gold. On the other hand, if you're considering selling gold, it's important to think carefully about your goals. Are you looking to capitalize on the current high prices? If so, this might be a reasonable time to lock in profits, especially if you need liquidity for other investments or expenses. However, selling now comes with the risk of missing out on further price increases. Analysts caution that gold could climb even higher if inflation rises or trade tensions worsen, so selling might mean leaving money on the table. For those on the fence, consider selling only a portion of your gold holdings. This way, you can secure some gains while still keeping a safety net in case prices continue to rise. The verdict. Ultimately, the decision to buy, hold, or sell gold comes down to your personal financial situation and how you view the current and future state of the economy. Gold has always been a powerful tool for managing risk, but timing and strategy are everything. Whether you're a seasoned investor or just starting out, the key is to stay informed and make decisions that align with your long-term goals. What's next for gold prices? The future of gold prices is as uncertain as the economic landscape driving them. Analysts are closely watching several key factors, with President Trump's trade policies sitting front and center. His tariffs on imports have already disrupted global trade, weakened the U.S. dollar, and stoked fears of inflation. If these tariffs escalate, or if new ones are introduced, the resulting uncertainty could push gold prices even higher as investors continue to flock to safe haven assets. But tariffs aren't the only factor at play. The Federal Reserve's monetary policy will have a significant influence on gold's trajectory. While the Fed has maintained higher interest rates to combat inflation, any signs of a pivot, such as cutting rates or signaling a more dovish stance, could further boost gold's appeal. Lower interest rates typically make gold more attractive because the opportunity cost of holding it decreases, encouraging more investment in the yellow metal. On the flip side, a stronger U.S. dollar could put downward pressure on gold prices. The dollar's performance is closely tied to geopolitical developments and economic data. If the dollar regains strength due to improving trade relations or robust economic growth, it could offset some of the recent gains in gold prices. However, given the ongoing uncertainty in global markets, a strong dollar recovery seems unlikely in the short term. Geopolitical tensions will also play a significant role in determining gold's future. Conflicts in key regions, changes in energy prices, and shifts in global alliances all have the potential to disrupt markets and drive demand for gold as a hedge. History has shown that in times of war or crisis, gold prices tend to surge as investors seek stability. Meanwhile, central banks around the world are continuing to stockpile gold, signaling long-term confidence in its value. Countries like China and Russia have been steadily increasing their reserves as a way to reduce reliance on the U.S. dollar and hedge against economic risks. This trend suggests that demand for gold could remain strong, even if individual investor sentiment fluctuates. Finally, let's not forget market psychology. Gold is often influenced by fear and speculation as much as by fundamentals. If inflation expectations rise or if new economic challenges emerge, like unexpected trade disruptions, financial crises, or natural disasters, gold prices could spike further, even beyond current levels. So, what's next for gold prices? The answer depends on a delicate balance of these interconnected factors. While some analysts predict continued growth, others warn that gold's rally could lose steam if global conditions stabilize. What's clear is that gold will remain a key player in the global economy, both as a hedge against uncertainty and as a barometer of investor sentiment. Well, in summary, the factors driving gold's prominence, Trump's tariffs, inflation concerns, and global market volatility underscore how interconnected our economic systems are. Whether you're considering buying, holding, or selling, one thing is certain. Staying informed and adapting to the ever-changing economic landscape is essential for making smart investment decisions. Thank you for watching. If you found this video insightful, don't forget to like, share, and subscribe to Economy Explorer for more updates on the global economy. And remember, every second counts in understanding the big picture, so stay tuned and don't skip a beat.